Okay, so we are going to look at a situation where government of Ghana will want to maybe purchase an asset or construct an asset, and they are going to be uh, taking a loan to finance that particular arrangement. So this is common in the government sector. Example, the construction of road. Most of the times, if we are not using the private public partnership agreement, we might be taking a loan towards to finance the construction. So this is going to be very important in the public sector. So we are going to be looking at how to deal with that issue. So we are going to be looking at the issues with the PPE. So the last time we said that PPE, we said that the initial cost of property, plants, and equipment are those costs that are indirectly incurred to make the asset ready for its intended use. And one of those costs is going to be this one. Okay. Assuming we want to purchase plants. Okay. We want to purchase plants. Since we want to purchase plants, we went to the bank to take a loan of 10 million to purchase this particular one. Okay. And the assets we purchased this, let's assume that this has been purchased on January. This has been purchased on January 2021. Okay. And the asset has been, so let's say this one, and the asset has been put into use. Okay, or the asset was ready for use on the same day. It's an asset that we are buying in a what? In each finished it. So the asset was put into use on the same day. Okay, let's come here. We are taking this particular loan specifically to finance the construction of the assets. Okay. What are the expenditure that we are going to be incurring on the loan? What will be the expenditure that we are going to be incurring on the loan? What will be the expenditure that we are going to incur on the loan?
Interest.
Is the interest, isn't it? The expenditure on the loan will be the interest. Do you agree to that?
Yes,
Yes, exactly.
yes,
The time that you are taking the loan, the asset has been put into use. The asset is ready for use on the same January 2021. You see that you are going to be incurring the interest after the asset has been put into use, isn't it? Because on the same
yes,
day, there will not be any interest. Okay, the same day there will not be any interest. So the interest will be, let's say, the first interest will be at the end of January. At this time, the asset is already in use, and any expenditure that you have incurred after the asset has been put into use or after the asset is ready for use, that expenditure is treated as what? It's an expense, or it is treated taking into consideration the impact that the expenditure is going to be having on the asset. So the interest that we are going to be incurring, which is expenditure on this particular loan, is going to be a subsequent expenditure as far as the asset is concerned, because the asset is already what available for use on the same day. Okay, so the interest that you are going to be incurring, it will be after the asset has been put into what? Into use, or the asset is ready for use, because the asset is ready for use on the same day you purchase the asset. So the interest over here, the interest that you are going to be incurring, let's say the interest is every year 1 million. This will start from this interest will be from the interest will have effect from January 1 to December, but the asset has been put into use, or the asset is ready for use on January 1. No interest has been incurred. So after expenditure, which will be the interest, will be expenditure after the asset has been put into use. So that will be a subsequent expenditure. Therefore, we expense that particular expenditure. But let's come here. Let's come here that the public sector entity is taking this loan to finance the construction of what? To finance the construction of a building. Okay, the construction of the building is going to be taking, let's say, 4 months. Okay, so we are taking the same loan. Okay, so the construction, let's say the construction starts January 1 2021, and the loan too has been taken on the same day, January 1, 2021, and the building is now taking 4 months. Okay, so let's say the loan that has been taken is still the 10 million. Okay, you can see that the assets, it has taken what? The asset has taken what? It has taken 4 months to be what? To be available for use. Okay, you can see that the loan interest also over here. We are going to be incurring expenditure on the loan for 4 months. Okay, for 4 months. Okay, the interest expense that we are going to be having for 4 months, is it going to be classified as a subsequent expenditure? Is it expenditure that we are incurring after the asset has been made available for use, or the asset has reached age state that it will be available for use, or is an interest that we are incurring before the asset has been made available for use, or has the asset is not in a condition for its intended use? Is it going to be after expense or expenditure before the asset has been what? Has been declared as what? As ready for use. The 4 months interest now, is it going to be expenditure after the asset is ready for use or before the asset is ready for use?
Before the asset is ready.
Before the asset is ready for use, isn't it? Okay. So we will take this these 4 months expenditure that we are incurring over here will be added to what? Will be added to the initial cost of the asset, because it's a cost that has been incurred directly on the asset, because we are taking the loan to finance the construction of the asset. If not for the construction of the building, there won't be any loan. So any expenditure that we incur on the loan, which is before the asset has been declared as what? Ready for use, that particular expenditure will be added to what? Will be added to the initial cost of the asset. Because the expenditure that we have incurred, that time the asset is not ready for use. So it will be seen as what? Part of the cost necessary to make the asset ready for use. But if the asset is already in the state that it will be used, the interest that you are going to be incurring will be after the asset has been put into use. And that will be treated as what? Subsequent expenditure. And this is the reason why we don't capitalize borrowing costs on assets that is already what? Available for what? Available for use. Because the expenditure will be classified as a subsequent expenditure. The interest will be expenditure after the asset has been put into use. So that will be a subsequent expenditure. We only capitalize when it's going to improve the capacity, efficiency, or it's going to enhance the performance of the asset, and it's going to extend the useful life of the asset. Interest expense can never do any of the two. So we expense it. But if the expenditure has been incurred before the asset is what? Is declared ready for use, then that expenditure will be seen as what? The initial cost, because the loan is specifically taken for the construction of the asset. So we are coming to look at a situation where we should add the interest on a loan taken to finance construction, purchase of an asset. Okay, we say that when the asset is ready for use already, before we have purchased it, any expenditure that we are going to be incurring on the loan taking is going to be seen as what? A subsequent expenditure, because the interest will accrue after the asset is now in use. So that will be a subsequent expenditure. The interest that we are going to be accruing before the asset will be declared ready for use, that interest should be counted, because the cost necessary to make the asset ready for what? Ready for use. So we have to capture it. So that's what we are going to be looking at. This is just the intro of whatever we are going to be looking at. Okay. So we are going to be looking at IPSAS 5, that is borrowing cost. But what do we mean by borrowing cost? Okay, what do we mean by borrowing cost? Let me just put it straightforward. We are just talking about, okay, the interest that should have been expensed if the loan has not been taken to finance the construction of the asset or the purchase of the asset. What would have been the interest that would have expensed? Okay, but since we are taking that particular loan to finance the construction of the asset, instead of us expensing that particular interest, let's now add it to the initial cost of the asset if it is qualified to be added. Okay, so What I would say is that if the government of Ghana is financing the construction from their reserves, please, they don't pay interest on their reserves. If they are issuing equity, if a public sector entity or public corporation is issuing equity to finance the construction of the asset, please, equity will pay dividends on it, and dividend is not interest, unless the shares is what preference shareholders, which according to IPSA 28 and IPSA 29 financial instruments, the redeemable preference shares are treated as what? Debt instruments. So their dividends are treated as finance costs. So it's only redeemable preference shares dividend that will be captured as interest because that they are treated as what? Debt instrument. We are talking about interest on borrowing. Interest that will be taken to profit or loss as an interest expense. So if they are financing the construction through equity, please, equity, we don't pay interest. So whether they have given information on those ones, no. You cannot capitalize but dividend because dividend is not interest. We are talking about the interest that should have been charged to statements of financial performance. But because it is now on a qualifying asset, the months or uh, the period the period for which the asset is under construction. Let's add the interest expense to the cost of the asset because the necessary cost to make the asset ready for use. So we are talking about only what? Only interest that would have been expense. So interest on bank overdrafts, interest on borrowing, whatever be the case. Okay. If they are using equity, please, there's not going to be any borrowing cost on that one. Okay. So let's come to what is the borrowing cost? What are we going to be terming as borrowing cost? Okay, the borrowing cost is any cost incurred is any cost incurred in connection with what? Borrowing of funds. So any cost that you are going to incur in connection with borrowing of funds. That's what we mean by what? Borrowing cost. Any cost any cost incurred in connection of what? Borrowing of funds. What we mean is that if the government of Ghana is going to take loan, if they have loan processing fee, if they have loan processing fee, the loan processing fee is also part of what? The borrowing cost. If they are issuing debentures and they have incurred issuing costs, the issuing cost is also going to be classified as borrowing cost because the cost incurred in connection with what? Obtaining what? Funds, borrowing. Okay. So all those things that we are going to be doing. Okay. What does the IPSAS define as what? As borrowing costs. So what are the expenses that are going to be included as borrowing costs? So examples of the expenses that should be included as well as borrowing costs. So anything that is going to be an expense will be part. So the example is interest, interest expense, or interest on bank overdrafts. Okay, interest on bank overdrafts, short-term, short-term loan, short-term loan, and long-term loan. Okay. Then any interest on bank overdraft, short-term loan, since it's going to be an interest and it is taken on an asset that is going to take a substantial period to be ready for use, that particular amount will be what? Will be added to the initial cost. Then we also come to amortization. So this has not been revised. So we are still using the old one. But those of you that are doing financial reporting, you can see that we are saying that interest expense calculated using the effective interest method. Okay, this is all the same thing. You put all this together. But this has not been revised. So we are still using the old one. Maybe if they revise, they also now bring the interest calculated using the effective interest method under uh IPSAS 29 and 28 or something. So we have the amortization of discounts or premiums, amortization of discounts or premiums. What do you mean by amortization of discount? Let's come here. Let's come here. Assuming we are issuing debentures, assuming we are issuing debentures. So the debentures that we are issuing, So let's say we are issuing 10% debenture. So we are issuing 10% debenture. We are issuing 10% debenture. Okay, for 20,000. But this has been issued at a discount of 5%. Okay, please, if you are going to the supermarket to buy something that is worth what? 20,000, and they are giving you discount of what? 5%. How much are you going to be paying? How much are you going to be paying?
119,
190 or
19,000.
You're going to be paying 19,000.
90.
Okay. So if you are paying the 19,000, the item that they will give to you, would the items worth 19,000 or 20,000?
90,000.
It will worth what, 20,000, isn't it?
Yes, sir.
Okay. So this is what will happen. You see, the we are selling the debentures to what? To the holders, those who are going to be buying debentures. The debentures will be given to them at what? At 20,000. But instead of us taking 20,000 from them, we are saying that we are giving them a discount of 5%. So they are paying only 19,000. But you have debentures in your books at what? At this one. So if the debentures is for 5 years, what it means is that we are giving a discount on an item that is for 5 years. The only time that you take all the discounts to profit or loss is where you are saying that you are issuing a discount on an item whose benefit is going to be consuming over a year. So you are giving a discount on what? On inventory. So if you are giving a discount on inventory, the inventory will be sold within a year. So the discount should also be taken to profit and loss because the item will be sold, the benefits will be sold or will be consumed in a year. But this is just for 5 years. For the purpose of faithful representation, it is going to be very wise for us to also spread the discount over 5 years because the discount is given in respect of an item which is going to be there for 5 years. So the benefits will be 5 years. So the cost should also be 5 years. So but in your books, you are going to be debiting cash or bank for 19,000. Credit discounts allowed because this is an expense for you. Okay, so 1,000. Then you now credit debentures. The debentures will be at the full amount of 20,000. Okay, let's assume that we are issuing these debentures. We are issuing these debentures for construction of building, which is going to take 2 years to be ready for us, to be ready for use. So what will happen is that the interest expense every year, the interest expense every year will be 0.1 multiplied by 20,000 because the debenture is this one, and this will be 2,000. So every year, since this asset is going to last for, since this asset is going to last for uh 2 years, every year we add the interest of what? Of 2,000 to the cost of the asset. So this year it will be 2,000 because the asset is not ready. So this 2,000 will be seen as the cost necessary. Then you also count the discounts. Okay, we count the discount. We are incurring the discount as a result of the debenture. If not for the debenture, the discount will not have been given to us. So this is what we do. Okay, so we also amortize the discounts. Amortizing the discount means that we are spreading the discount over the useful life of the item that we are issuing the discount on. So that will be 1,000 divided by 5. So we are having 200. Okay, so this discount would have also be taken to profit or loss. But since the discount is relating to an item that will be used for construction of the asset, this discount of 200 will also be seen as part of what? The borrowing cost. Okay, so you now have your borrowing cost, the interest to be capitalized will be your normal interest plus your amortization of the discount. Amortization of the discount is that you are spreading the discount over the useful life of the item that you are giving the discount in respect of. So this would have been the interest expense for the discount for the first year. But since the asset is still under construction, These two, instead of you taking them to profit or loss, you add them to what? To the initial cost of the assets. So this is what we mean by the amortization of the discounts. I'll come to the issue of the premium. Okay. You are going to be issuing this at a value more than what? More than the actual value. So let's say we are issuing this at a premium of what? Of 5%. It means that we are selling the thing to the people at what? At 21,000. Okay. That will be at 21,000. So our interest expense, okay, it's not that the value of the item is 21,000. They are paying 21,000. So we are having a gain of 1,000. We are selling to them more than the what? The price of the item. So we are going to be having a gain of 1,000, but the item will be given to them at what? At 20,000. Okay. So the interest will be 0.1 multiplied by 20,000. So you have 2,000 here. Then you come to your premium. The premium is given in respect of an item for 5 years. So the premium of 1,000 should also be spread. It's an income to us, so it should be spread over what? Over the useful life of the item. So we have 1,000 divided by 5, and that will give us 200. So this will be treated as an expense, and the premium will be treated as what? As an income. So if you're amortizing, it means that assuming this is not relating to qualifying assets, you should have taken this figure to profit to your statement of financial performance as interest expense, and you take the premium also there as an income. So in effect, you are taking only 1,800 to the statement of financial performance as an expense, because we are having 2,000 and a gain of what? 200 is subtracted from that. So you just bring your this figure, the next, this is an expense, this is an income, net it and bring it to and add it to what? To the initial cost of the asset. If the asset is still under construction, this one is going to be these two: expense, interest. This is discount allowed, expense. They are all expenses. Put them together and subtract. Okay. But if they are giving you information on financial instrument, what they do is that mostly they will capitalize the what? The cost, the discount or the premium. Then they will not calculate what we call effective interest rates. Okay, so those of us that are doing financial reporting, we have done that already. So I will not waste time on that. Okay, we also have we also have we also have the second one, the third one, which is what we call the amortization of any auxiliary uh any let me check. So amortization of any auxiliary cost. Okay, so okay, not auxiliary. Okay, any amortization of any ancillary cost. Okay, incurred in connection with that particular figure. So let me write this one. Any ancillary cost in connection with the borrowing. These ancillary costs that they are talking about is that if you go to the bank, you incur a loan processing fee. If you are issuing debentures, you incur issuing costs, or you pay to the what? To the brokers to get a buyer for you. All those costs that you are going to be incurring is the one that they are calling the what? The ancillary cost. So if you are going for a loan and they're asking you for loan processing, it's a cost that you are incurring to obtain the what? The loan. Okay. So if the transaction cost, we mostly call it transaction cost. So if the transaction cost for the item for the same debenture is, let's say, 2,000. Okay. The debenture is for 5 years. So you also have to amortize this one. So the transaction cost, you have to spread it over what? Over 5 years. So every year you'll be having 400. So if the asset is under construction for a full year, what will happen is that this 400 will be added to the interest that should have been paid. This is a cost that you are incurring, transaction cost. Okay. This is a cost. This is an expense to you. Okay. But since it is relating to an item that will last for more than a year, it means that you have to spread the cost also over what? Over the 5 years or the useful life. So every year we take 400 to profit or loss as an expense, or take it to statement of financial performance as an expense. And since this is relating to a borrowing, or this is relating to a cost that has been incurred necessary to purchase an asset, then we add the 400 as an expense to the interest every year if the asset is under construction for full year. So 2,400 will be added to the initial cost of the asset. So the amortization just means that you are spreading the cost over the useful life of what? Of the instruments that you are incurring these costs in respect of what? In respect of, okay, let's come to the last one, which is going to be, so I'll have what? Exchange rate differences. Exchange rate differences. Exchange rate differences. To the extent, exchange rate differences uh, in relation to, so let me just say, in relation to translation of what? Translation of a finance cost. Okay. So what you have to know is that if you are borrowing, if you are borrowing in what? In a foreign currency. If you are borrowing in a foreign currency, you are going to be paying interest. If you are paying the interest in a foreign currency, the interest is always translated using what we call the average rates. Okay, the interest. So profit or loss items, foreign profit or loss items are translated using average rate. So the question will give you the average rate. Why average rate? Because a lot of issues have happened during the year. So let's just use average because there was a lot of fluctuation in the exchange rate during the year. So let's use average. So we always use average. So the time that you are calculating the finance cost in the foreign currency, you are using average rates. So let's say the average rate that time it was 12 CD is equal to USD1, the average rate. So you translate it using the average rate. Let's say the interest that we are paying is 2,000. So we translate this to to the statement of financial performance using 12 CDs. Okay, but the time that you paid this finance cost, the exchange rate was let's say 13 CD is to 1 CD. So it means that you have paid 1 CD for every dollar more than what you are taking to profit or loss. So you can see that in a profit or loss, we are having 2,000 multiplied by 12. But the amount that we are paying is 2,000 multiplied by 13. We are paying 1 CD in what? In excess. So there will be an exchange rate of 2,000 Ghana cedis. Okay. This 2,000 Ghana cedis is resulting from the translation of the finance cost. So we treat that as well as an exchange rate differences because the finance cost that we are having is lower than this one. So we add it to the initial cost of the asset if this is relating to a qualifying asset. But if you count the translation of the payment of the principal does not form part of the interest. We are only interested in the expense, the interest expense that would have been taken to profit or loss had it not been this particular loan is taken in respect of what? Of a qualifying asset. The last one is a finance charges in respect of what? Finance lease. So we'll be looking at IPSAS 13. That is what? Leases. Okay, so we can say we are going to be constructing the building, but we don't have the machines to do that. So we are now leasing the machine on what? On finance leases. So the finance leases, we are going to present value the lease payment, which we are going to be paying interest. Okay, so the interest that we are going to be charging, which is the finance cost interest on the finance lease, since we are taking the what? The machines purposely to finance the construction, the finance cost that we are going to be calculating on the lease, which is going to be every year. If the asset is still under construction, because we are taking the machines purposely for the construction, the interest that should have been taken to statements of what? Financial performance in respect of interest expense, if it is a lease, we add that one to what? To the initial cost of the assets, because it's the cost that we are incurring because of us taking the machines to construct the asset. It's a necessary cost to the asset. If not for the asset, we will not have taken that machine on the finance list. So the portion or the month, the period under which the asset is under construction, or the period for which the asset is under construction, that finance cost that would have been taken to statement of financial performance in relation to finance list, you will now capitalize it. So if it is for 6 months, you find 6 months of the finance list and add it. But in most cases, they are here to this is uh public sector. So they have not done anything on borrowing costs yet. Okay. Then let's come here. Which assets? Okay. Which asset do we capitalize the borrowing cost on? Borrowing cost is capitalized on what we call a qualifying asset. What do you mean by a qualifying asset? Qualifying asset is an asset that is going to be taking a substantial period to be ready for use. Okay. We do this on qualifying assets. What do we mean by qualifying assets? Qualifying assets is an asset that is going to take a substantial period to be ready for use. The standard has not defined what a substantial period is. So if the asset is taking 2 weeks to be ready for use, please ignore the borrowing cost. 2 months is fine, 3 months is fine, even 1 month is fine, depending on the volume of the expense. But if it is in weeks, like 2 weeks, 1 week, please just ignore. But if it is maybe 2 months, 1 month, depending on the volume of it, but 2 months, 3 months, 4 months, 5 months, that is fine. Okay. Although the standard has not defined what a substantial period is. Okay, but in 2 weeks or less than months, please ignore. 2 months, 3 months, 4 months, that is fine. Okay. What does the standard define as qualifying assets? So we have the property, plant, and equipment. We have the power generating facilities. We have inventories. So if the inventories, we are going to be taking some inventories like those drinks, whiskey, and those people, they are going to be taking a substantial period before they'll even be ready for you. So if you are taking loan to finance them, you capitalize the what? The the interest that would have been taken to profit or loss for the period in which the asset is under construction. Okay. We are saying that the asset that is going to take a substantial period to be ready for use. That is the asset. Because we have established from the beginning that if the asset is ready for use at the day that it has been purchased, the interest expense will be treated as a subsequent expenditure because we are going to incur the interest after the asset has been put into use. So we are talking about qualifying assets here. Although we are talking about qualifying assets, if you have issues with land, okay, if you buy land and you have taken loan to buy the land, okay, the capitalization of the borrowing cost on the land depends on the purpose for which you are going to be using the land. Okay. So if you are buying the land for construction of building, the land will be seen as one of the activities necessary to make the building available for what? For use, or ready for use. So in that case, the loan that you have taken, to finance the purchase of the land, interest will be capitalized because the land is not what is not acquired purposely for its own use, but to help us build a structure. So if not for the acquisition of the land, building will not be there. So the land will be seen as one of the activities necessary to make the building available for use. So it will be seen as one of the costs necessary to make the building ready for use. So we capitalize it. But if you are buying the land for its own use, let's say to farm on it and those things, means that the land is already in a state that you can start using it. So it's not going to be a qualifying asset. But if you are going to develop the land, so is it going to take some period? Sometimes you buy land, you have to level the land again. So if you are taking loan to finance those activities, if it's going to take a substantial period for the land to be ready for use, that is also going to be capitalized. So capitalization of borrowing cost on the land depends on the purpose for acquiring that particular land. So if they want to test you on that, you can actually remember something like that. Okay, what are what are the interest expense that are qualified for capitalization? We are saying that the loan should be specifically, or the loan should be acquired in what? In connection with acquisition, construction, upgrading, or whatever of what? Of a qualifying asset. So if you are taking a loan and you're not taking a loan for construction of a qualifying asset, that loan is not a cost specifically incurred to make the asset ready for use. So that loan will not be captured. So we are talking about only loans that are taken to finance the construction, acquisition, or whatever of a qualifying asset. When should we start capitalizing the borrowing cost? Okay. When should capitalization begin? Okay. When should capitalization begin for what? For a borrowing cost. Capitalization will begin for borrowing cost when construction has started and when you have taken the loan towards the construction of that particular asset. So we'll be looking at conditions for recognizing, conditions for recognizing, or when should capitalization starts. The first one is that expenditure for the asset has been incurred. Okay, expenditure has been incurred. Expenditure has been incurred on the assets. Expenditure has been incurred on the asset. This expenditure can be purchase of raw materials towards the acquisition, payment to labor. Okay, so what we are doing over here is that we are constructing a building. So we have now purchased cement and those things, the raw material and those things. Or we have started paying people. Okay, that is, it means that we have incurred, expenditure has been incurred on the asset, and this will be you paying for the necessary materials that you need for construction of the asset. Okay, so you have started buying raw materials and those things. It means that construction will soon start. Okay, so the next one is what? Borrowing cost has been incurred. Borrowing cost has been incurred. Borrowing cost has been incurred. A borrowing cost has been incurred means is that loan has been taken and the loan has been used on the assets. The borrowing cost over here is the interest and any other related costs in connection with what? In connection with borrowing. It's not the loan itself. So if we have taken the loan, has the loan been used on the asset? The loan has not been used on the asset. You are not going to be what? Capitalizing anything because the loan has not been used on the asset. So borrowing cost has been incurred. It means that the loan has been taken and the loan has been used on the assets. That's what we mean by borrowing cost has been incurred. Okay. Activities necessary. Activities necessary. So the second one is activities necessary. Activities necessary. Activities necessary to make the assets ready for use. To make the assets ready for use. Ready for use as what? Has begun or started. Has started or begun. Okay, what it means is that we have started taking what? We have taken building permits. Okay, we have taken building permits. So since we have taken a building permit towards the construction or whatever, it means that the asset is going to be what? It's probable because since we are taking building permit, we are going to construct the asset. Or we have cleared the site preparation or the site clearing of sites and all those issues. What you have to know is that all these conditions, all all the conditions must be met. All the conditions must be met before borrowing costs will be before capitalization of borrowing costs will start. All the conditions must be what? Must be met. What does it mean? If you have incurred expenditure on the assets, but you are using your own money, it means that borrowing cost has not been incurred. We are talking about the interest that would have been taken to profit or loss. Let's now add it to the initial cost of the asset. So if you have incurred expenditure on the asset, the expenditure can be your own reserves, which you are not paying interest on it. Okay. You can obtain building permits. The building permit that you have obtained, you have used what? Your own money. You can purchase raw material, you are using your own money. You can incur borrowing costs, but the loan has not been used on the assets. You cannot capitalize. So all these conditions must be what? Must be met before capitalization will start. Okay. When do you? There can happen that within some time, within some time, okay, the construction will stop. So maybe there can be an issue like right now, there have been excessive rainfall at the site. So we have currently will stop the construction of the asset. The question is, must the borrowing cost also stop within that period? Must the borrowing capitalization of the borrowing cost must it also stop within that particular period? Okay, so when do we suspend? When do we suspend capitalization of what of borrowing costs? So suspension, okay, suspension. When do we suspend capitalization of borrowing costs? I'm saying that we are doing the construction. We have estimated that it will take 2 years for the asset to be ready for use. It will take 2 years for the asset to be ready for use. But what happened is that there was excessive rainfall at the site, and we have now stopped. So the place is crowded. So we have now stopped the construction for some time. The question is, must we continue capitalizing the borrowing cost? Must we continue adding the borrowing cost to the initial cost of the asset? Or we have to now what? We have to now suspend the capitalization also. Okay. The we are going to suspend, okay, we are going to suspend what? The borrowing cost, capitalization of the borrowing cost, when the reason for the stop work, okay, the reason for the stop work, it is something that is what? It is something that is under uh it's something that has nothing to do with what administrative and administrative and technical work of the what of the it's not relating to administrative and technical work with regards to the work. Okay. So what we mean is that suspension, borrowing costs should be suspended when there's issues like what? Shortage of raw materials, shortage of raw materials, shortage of raw materials. We have litigation issues. So those issues that they have been saying, stop work, produce permits, and those issues. The so we also have maybe strike. So the workers are now on strike. There was an issue of flood and those natural disasters. But capitalization should continue. Capitalization should continue. Continue capitalization. Continue capitalization. Please, these are just few of what of the examples that we should suspend capitalization. So continue capitalization when there was when the reason for the delay is administrative and technically related. I will tell you what we mean by administrative and technically was related. Administrative and technically related issues. Okay. What will happen is that the design that we are saying that we are going to be the design that we are going to be having. So now there's some changes in the design. So they are saying that the people to come for or the people to come for a workshop so that they will train them on the use of that design. That is something that is going to improve. That's an administrative and technically related issues. It's going to improve the what? The situation of the what? Of the building. Okay, so if you come here, that one that they have been saying produce permits, stop work, produce permits. This is not administrative related. Okay, it's not administrative related. It's something that is not going to improve. If you go for permits, the design that you want to have is the same design that you have. Okay, but we are talking about capitalization should continue when the thing is going to when the reason is going to improve, when the reason is going to improve what the nature of the work that we are going to be doing. So administrative related. Now we have started, and the issue now we want to now raise the place again. Raising the place again is also going to improve the kind of the work that we are going to be doing. So if it's about raising the site again, that is administrative and technically related. Okay. If they are saying that people should come for workshop so that we will do whatever they want to do. What it means is that if not for the training, work should have been going on at the site. If not for there was the upgrading that we are doing. Work should have been going on there. Okay, but for the strike and those ones, there's materials over there, but work is not going on. It's not administrative related. Administrative related means that if not for this, work should have been going on because the people they don't have any excuse. They will be working, but they say they should come for workshop. So it's because of the workshop that they are not working. So if not for the workshop, they should have been working on that particular issue. So you always pay attention to the reason. You always pay attention to the reason. If the reason is administrative related, please you continue capitalizing. Whether work has stopped or not, you still what? Capitalizing the borrowing cost. When do we cease? Uh, I'll say something. Cessation of borrowing cost. So cessation of borrowing cost. Cessation means is that when do we stop? When do we stop capitalizing? We stop capitalizing borrowing costs when the majority of the work necessary to make the asset ready for use has been completed. So these are the construction that we are doing. Okay. We have done the work, everything is what? Everything is perfect. We have done cementing. It is left with only painting. You see a situations where people even move into their what? Into their apartment without what? Without painting. That is a minor work. That is a minor work as far as what? As far as the work is concerned. So if substantially, if all the work necessary to make the assets ready for use has been what uh, has been substantially what's completed. Okay, so if majority of the work has been done and it's left with some minor maintenance and issues. So maybe we have to fix light and those things now. Those fixing we have done the what we have done the wiring already. So you just have to buy bulb and fix them. Fixing bulb has nothing to do with what construction of the asset. Painting has nothing to do with the construction of the asset because the construction itself is the building. We have done that. Painting has nothing. So those painting and those things are not going to be seen as what one of the activities to make the asset ready. Some people they can start using their structure without painting it, so it's not a big deal. So when substantially all the work necessary to make the assets ready for what? Ready for you has been completed. However, if the constructions are done in stages, what do we mean? If you are constructing a story building and you are going to be completing in what, let's say in stages. So you have done the ground floor. Okay. So you are doing like four what? You are building like four-story building. You have done the ground floor there. You have finished it. It means that you now move on to the first floor, the second floor, and those ones. You have not done them yet. It means that they are still under construction. So the portion of the borrowing cost, this is which is for the ground floor will now stop. You will not capitalize it again because it's not ready. Then you now move on to the first floor. You start capitalizing. If it is also done, you stop. Then second floor. So when construction is done in stages, when construction is done in stages, what happened is that the capitalization will stop for the ones that have been completed and will continue for the ones that are still under what? Under construction. Okay. So the question now is how do we determine what we are calling the borrowing cost? How do we determine what we are calling the borrowing cost? We determine the expense that would have been taken to profit or loss had it not been that the loan has been taken specifically or has been taken or has been used on a construction asset. Okay, so we look at what we call specific borrowing. So we look at specific borrowing, which we are going to be looking at specific borrowing here. Okay, so we have specific borrowing, specific borrowing is the what? Is the amount that is specifically taken to finance the construction of the asset. It's not taken for any other purpose. It's taken for whatever purpose that you are doing. So let's come here. Assuming you went to GCB, assuming you went to GCB to go and take 20,000 Ghana cedis to finance so the loan is 10%. So you are going to GCB to take a loan of what? Of 10% to finance the construction of your of your uh, chamber and hall self-contained or whatever, which is 20,000. Okay. This is the total amount. Please let me also put this one on record. You can also specifically borrow loan from different sources. Okay. So the kind of the structure, the kind of building that you want to put there. Okay, the total amount that you can spend on it is what is 100,000 Ghana cedis. But the time that you went to GCB, they say they cannot give you all the loan, so they have given you 1,000. You go to a different bank and take loan. You can see that you are taking the 100,000 specifically for the construction, but you are taking it from different sources. That is not a general borrowing. You are specifically borrowing this money from different sources towards the construction. That's not a general borrowing. General borrowing is where you are using your existing borrowing. What it means is that you have taken loans for different purposes. But now the construction or this particular project comes up. So you say that okay, already I have some money over here, I have some loans. So I want to use the existing loan to finance the construction. That's why we have general borrowing. So general borrowing, we are using the existing what? Existing borrowing or existing loan to finance. But a specific one means that we are going out there to look for funds towards the construction of whatever asset that we want to construct. That's what we call the specific borrowing. So you can take money from different banks, which will still be classified as what specific borrowing. You are taking the money from the banks differently, specifically for the construction or whatever you are doing. Okay, let's come here. So you have taken a loan from GCB. You have taken a loan from GCB for let's see an amount of what 20,000 towards the construction of your single room, uh, towards the construction of chamber and hall self-contained. But you have used for the whole year. You are saying that this will take 2 years, but for the whole year, you have used 5,000 of the money. The question is, if GCB wants to charge you interest, will they charge you interest on the amount that you have used or the amount that you have taken?
The amount that you've taken.
On the amount you have taken.
That will be how much? How much have you taken?
20,000.
So the
20,000.
so the interest for the year will be what?
Every 2,000.
Okay. So if you were the one, what are you going to be doing with the remaining? You can see that you have used only what? Only 5,000. You have 15,000 there. Okay. You know that whether you have used all the money or not, you pay interest on the full amount because they will charge you interest on the amount that you have taken, not the amount that you have used. What are you going to be doing? What are you going to be doing as a rational being? What are you going to be doing? You know that you use only 5,000. Will you put the 15,000 just there, or you do something with it?
You invest the
You
15,000.
can invest it.
Okay, so you invest it to get so the interest that would have been taken to profit or loss if this particular one should not be, that would have been 0.1 multiplied by 20,000. So we have 2,000. So that is the interest expense. So let's come here. So you know that you are going to use only 5,000. So for the time that you have taken a loan, you have now deposited or you put the 15,000 into a particular account. You'll be having investment income. Let's say they are paying you 5% on that or 8% on that. Your interest income will be 0.05 multiplied by the 15,000. How much are we having?
750.
Okay, 750.
50.
Okay, assuming this is not in respect of qualifying assets, you'll be taking 2,000 as an interest expense, and you'll be taking 750 as what as income to profit or loss, or to statement of what uh financial performance. In effect, how much are you taking to the statement of financial performance?
2,000 less 750.
1250.
That will be 1250, isn't it? Okay.
1250.
So the question now is, since you are using this particular loan to finance the construction of a qualifying asset, instead of you expensing the 1250, add it to the initial cost of the asset. That is the question or that is the issue that we are raising. That is the issue that we are raising. So instead of you expensing this net amount, just add it to the construction of the what of the asset. You are taking the 20,000. Let's come here. You are taking the 20,000. You are taking the 20,000 for just a building. But if you are taking the 20,000 now, okay, let's assume that you are taking the 20,000 for two projects. You are taking the 20,000 for two projects. Whatever be the case, whether you are taking it for one project or zero project, you still pay the interest on the full amount that you have taken because you have taken the money purposely for the construction of this one. It is not their fault that you have used only one part of it. They will charge you interest on the amount given to you. So even if you use 5,000, the 15,000 will still be there in respect of what? This particular project. So you're not going to be using the 15,000 as well. But assuming you have taken the money to finance two projects. So let's say building A and building B. Okay. You have now realized that you are going to be using a total amount of 8,000 on this, total amount of 12,000 on this. Whether you have used only 5,000 on this and you have used 6,000 on this, you will still pay the interest on the full amount that you have taken, which is 20,000. So what you do now is that the interest of the 2,000, you will now share it based on the amount that has been allocated for the two projects. So you now have 8 over 20 multiplied by this one, or you do your 0.1 multiplied by the 8,000. That is the portion of the loan that you are using on this one. So 8,000, interest of 8,000 will be coming here. You have 800, 0.1 multiplied by 12,000. And this will be 1,200. So you have a total of what? Total of 2,000. What you do over here is that you are left with 3,000. Did you invest it? If you invest it, how much are you getting as interest? You are left with 6,000. Did you invest it? If you invest it, how much are you getting as interest? So you calculate the investment income and take it from the total amount over here. So whatever be the case, you are going to be having that particular one. How do we determine borrowing cost for a specific borrowing? It is the actual interest, specific borrowing. The borrowing cost is the actual interest that would have been taken, actual interest that would have been taken to profit or loss, less any what, any interest income from investing was the temporary was unused funds. That's how we go about it. So they had the actual interest less was any temporary was invested funds. So let's take some two questions on that before we move on to general borrowing. So let's take two on that and move on to the the general borrowing. So it's not a big deal. Let's take two two questions. Then we have, so let's take the first example there. Let's try the first example there.
Gladys.
Yeah, that is it. Anti anyone can read because of the time constraint. Anyone can read.
Okay. GOG contracted a loan of 120 million for the construction of National Stadium that will be completed in a 5 years time. The loan was contracted on 31st March 2020 at an interest of 10%. At the end of 31st December 2020 financial year, a total of 20 million of the loan has been spent on the project. The government received 1 million Ghana cedis as a returns on funds as part of the loan that puts into a short-term investment. Determine the borrowing cost to be capitalized.
Okay, so the loan has been taken on what? On 31st March. Okay, so let me write this one before we start. Okay. You have to always look at the timing of the borrowing and the what and the construction. Sometimes the loan can be taken on January 1, 2021. Whilst construction will start from April 1, okay, 2021. Capitalization will start from when the when construction starts. Because it's the time that we started working on the assets. So the assets construction of the assets will start from this one. Although we have taken the money earlier, it means that the first 3 months there were no assets, which is January to March. The interest for this particular period will be taken to profit or loss because another time there was no asset under construction. So what are we going to be adding it to? So if you have taken the loan before the construction, capitalization starts from the date of the construction. If you have started the construction before taking the loan, okay, capitalization will start from when the loan has been taken. So we can start the construction from January, but the loan has been taken on 1st April. What it means is that there was no loan from January. We started using the loan on the project from 1st April. So capitalization will start from 1st April. So you always have to pay attention to that. So let's come here. They are saying that the loan has been taken on 31st March 2020 at an interest of 10%. They have not told us when construction has started. So we assume that the construction started on the day the loan has been taken. Okay. The asset is still under construction because they have spent only 20 million of the loan. It means that 100 million has not been spent. So it means that the construction is not completed. Okay. So from 31st March to December 2020, how many months is that?
It's 9 months.
Okay. So assuming this loan has been taken to buy equipment or whatever, the interest expense would have been the 10% on the full amount taken. The interest expense would have been 0.1 multiplied by 120 multiplied by 9/12. Do you agree? Okay, how much are we getting? 9 million. Okay. Okay. So this would have been taken to statement of financial performance. But they can say that they are telling you that we have been able to invest what the 100 million which has not been used, and we have gotten what interest income of 9 million. So we are going to be what we are going to be expensing only 8 million. So our borrowing cost over here, our borrowing cost will be the interest expense, will be the interest expense of 9 million. Okay, minus what? Investment income of 1 million. That will give us 8 million. Sometimes the question can ask you the cost of the asset up to date. The cost of the asset up to date. Okay, how much has been spent on the asset? What is the cost of the asset? How much has been spent on the asset so far? 20 million.
129.
Okay.
128.
No, not 120. You have not used all the 120 on the asset. When you have used all the 120 on the asset, it means that the asset has been completed. But right now, what is the cost incurred on the asset? That's 20 million. So the portion of the work that you have done on the asset so far is 20 million. So the cost of the asset now is 20 million because the asset is not completed. If it is completed, that is why you have the 120. So you have incurred only 20 million. Okay, if you are building a structure and you have spent only 20 million on the structure for now, someone asks you, okay, what is the cost of the asset now in each stage now, uncompleted state? You tell the person that you have spent so far 20 million. That is the cost of the asset that you have, the uncompleted one. That is the amount that you have spent. So 20 million. So if they ask you for the cost of the asset up to today, the cost of the asset will be the amount that you have spent on the asset up to now plus what? Plus the borrowing cost. That will be 28. So we are not talking about the cost of the completed asset, the cost of the asset at the current stage. That is the cost of the asset that they're asking you. Okay, let's take another one. Then we now forget about that and now move on to the issue of the general borrowing, and we see what we can do there. General borrowing, general borrowing. So okay, someone should take that number 4 for me.
Therefore, on 1st January 2021, the University of Ghana borrowed 30 million to finance the building of 2 student hostels, both of which were expected to take a year to complete. Construction started 1st January 2021. The loan facility was drawn down on 1st January 2021 and was utilized as follows, with the remaining funds invested temporarily. The building 1 and building 2 on 1st January 2021 was, building 1 was 5 million, building 2 was 10 million. And 1st July 2021, building 1 was 5 million, building 2 was is 10 million. The loan interest rate was 30% per annum, and the university would invest surplus funds at 20% per annum. Required. Ignoring compound interest, calculate the borrowing cost which may be capitalized for each of the building, and consequently the cost of which of the building as at 31st December 2021.
Okay, thank you. So how much are we taking? What is the total loan that we are taking?
30 million.
Okay, so assuming we are not taking, this loan to finance the construction of building, what would have been the interest that we are going to be paying for the whole year? Would that be 30% on the 30 million?
Let's say 30%.
Okay. So the interest, this loan is a specific loan. It's a loan that we are taking specifically to finance the construction of 2 buildings. So we should have been paying interest of 30% on 30 million. If this should not be, because we have taken 30 million, we have taken 30 million from the bank to finance the construction of this particular one. So we come to question number 4, and I'll have University of Ghana. Okay, so the total interest, or let me just say the actual interest, if this should not be in respect of what construction, we'll be paying interest of 0.3 multiplied by 30 million. How much are we having? That will be for a full year. Okay. So this 9 million now, this is the total interest. This is the total interest that would have been paid. But this loan has been used on what? On a qualifying asset. Construction started on what? On 1st January.
July.
Isn't it? Construction started on 1st January, and the loan has also been taken on 1st January. So capitalization will start from the 1st January. Okay. What is the total amount of money that we are using on building 1?
5 million.
No.
10 million.
We are using
10,000.
10 million. We are using 10 million on building 1. It's 10 million, but it's just that we are not using all of them at once. But we are specifically using 10 million for building 1, and we are using what?
20 million for
Okay, so it means that the interest on the loan of 9 million will now be shared among how the loan has been disbursed. So we are using 10 million. 10 million has been allocated to building 1. 20 million has been allocated to building 2. But just that we are not using the money at once. Whether you are using all the money or not, please the bank will charge you interest on the total amount that you have taken. So we have taken 10 million from the bank to finance the construction of building one. We pay interest of what? 30% on 10 million every year. Whether we have used all the money or not, we pay interest of 30% on the 10 million. We now pay interest of what? 30% on 20 million, whether we have used all the money or not. What the best thing that we can do is to invest the what? The money that we are here to what? We are here to use. Whatever be the case, you pay interest on the full amount. It's not therefore that you are using some part of the money. So we come to the interest over here. I'll look at the apportionment of the interest. So I'll be doing it in two ways. So the apportionment of the interest, we have building one. Building one will be 10 million out of 30 million multiplied by the 9 million interest, and that will give us 3 million. Okay. Or building one, the interest for building one, you can ask yourself, how much am I taking specifically to finance the construction of the building one? That is 10 million. So have 0.3 multiplied by 10 million. I'll be having 3 million for that. Okay. So you have 3 million. So I'll come to building two. Okay. I'm using 20 million. So I'll have this figure multiplied by the total interest. I'll be having 6 million.
6 million.
Or building two will be 0.3 multiplied by the money that I'm specifically taking. And that will give us 6 million. Okay. Let's come here. These are the interests that we are going to be paying, whether you have used all the money or not. But would there be any investment of temporary what? Investment of
And
any
yes,
temporary funds for any of the
yes,
projects? Okay. So you can see that at the beginning of this year, 10 million has been allocated to 10 million has been allocated, 20 million has been allocated. But how much do we put in the project from the beginning? For
5
building one,
million.
5
Building
million.
one is 5 million.
Okay.
Building
And then
one and then 10.
10 million for building two.
and the second 5 million has been used on 1st July. What it means is that we are going to be putting the remaining 5 million from January to June. Do you agree? Then we now go and withdraw it in what? On 1st July and now use it. Do you agree with us? That we are going to be
yes,
investing the remaining 5 million for 6 months. Okay. We have 10 million in the account, but we know that we are going to be using 5 million from January until July before we need additional 5 million. So we just go and put the 5 million somewhere from that date, and we come and withdraw the money from what? From 1st July. So we invest it from January to June. This one to the 10 million will be invested from January to June. So let's now calculate the interest income that we are going to be getting on that. So I'll come to the investment income over here. Investment income. Okay, the investment income, I'll have building one, which is going to be from January to June. We invest from January to June, and that will be 0.2 multiplied by 5,000. 0.2 multiplied by 5 million. Let me just write 5 million. 5 million multiplied by 6 over 12. Do you agree? What are we having?
500,000. 500,000.
Okay, that will be 0.5 million. Okay, let's come to building two. 10 million will be invested. So that will be 0.2 multiplied by 10 million multiplied by 6 over 12. What are we having?
1 million.
Okay, 1 million. So we invest the 10 million from January to June. We will go and withdraw it from what? From 1st July. So that will be there for 6 months. So let's count the borrowing cost for them now. So they say we should calculate the borrowing cost. So the borrowing cost, this is going to be for a full year. This is a full year. So we add the building has taken a full year to be ready for what? ready for use. So the full year will be capitalized. So I have the building 1 here, and I'll have building 2 over here. So I have my currency here in million, Okay. So I'll have the interest expense here, interest expense of 3 and of 6. So I have the investment income that is going to be reducing. Now interest here, that is 0.5, and that is going to be 1. So the borrowing cost will be 2.5 million, and this will be 5 million. They're asking me for the cost of the assets at the end of the year. Okay, the cost of the assets, what is the total amount spent on building 1 at the end of the year? So I have amounts spent. What is the total amount spent on the, what is the total amount spent up to date,
10
which is the
million.
end of, okay, that will be 10 million.
37.5.
Okay, that will be 10 million. This will be 20 million. So we now add a borrowing cost to it. That will be 2.5, and that will be 5. So we have the 12.5 here, and we have 25 million. So this is the, please don't put the two together. The two buildings can be having different useful lives, so you cannot combine them. So you have your 12.5 over here as what, as the cost of the building at the end of the year. We have spent 10 million on the first one and 20 million on the second one. This is about the specific borrowing. Okay. We will be looking at the issue of general borrowing. The general borrowing is we don't want to go out and take money. We don't want to go out and take money to finance the construction. We want to use loans that we have already taken, loans that we have already taken. We want to finance from the loan that has already been taken, the loans that has already been taken by us. That's what we are going to be using. So we have general borrowing. So general borrowing, we are going to be utilizing existing borrowing. So we have taken some loan, to do other projects, but we still have some funds on that particular loan. So instead of us going out to take loan to finance that one, we want to now utilize what, our existing loan. And existing loan is not going to be just one. It's going to be from a pool of what? A pool of funds. So you take some money from one place and you take some money. So you just, some people will see you have taken the money small and put it together. So maybe we can have 10% loan, 10% loan notes there. Okay, this 10% loan notes, the amount is 10,000. So we have 10,000 taken. We can have something like 8% loan notes. Okay, 8% loan notes. And that is going to be, let's say, 20,000. And we also have 10% debentures. Okay, this is the existing borrowings that we have. And the amount on it is what? Is 30,000. So we have taken, let's see, the amount taken. So let me see, on January, I'll say full year. So January to December, the amount that we have spent, on the project is 10,000. So the question now is, what is the interest expense in relation to the amount that has been spent on the project? That's what we are going to be looking at. You can see that this 10,000, don't assume that the 10,000 has been taken from the benches. No, you have taken the money small. So you can take 5,000 from here, you can take 2,000 from here, and you take 3,000 from here, because these are not monies that you are specifically using on the project. So you are taking the money small. So you cannot say that, okay, I have 30,000 on 10%, so I will take 10,000 from the 10%. No, you are taking the money small. Unless the debentures are specifically secured to finance the construction. That is the time that you take, or you use all the specific project before you use all the specific borrowing before you go to the general borrowing. Okay, so the question now is, what is the interest in relation to the 10,000 that you have taken small from all these projects? It's going to be very difficult for you because 10%, 8%, 10%. The rates are different. So what is the rate? What is that one rate that we can apply on this one? What is that one rate that we can apply on this one? So first of all, you have to establish the total interest. So the money has been taken from these three sources. So you ask yourself, what is the total interest that you are paying on these various funds? Let's come to the 10% loan note. The 10% loan note, the interest will be 0.1 multiplied by 10,000. And you are going to be getting 1,000. Okay. If you count to 8% loan notes, the interest will be 0.08 multiplied by 20,000. And we are going to be getting what? How much are we getting? So that'll be one.
1,600.
Okay, that'll be
1,600.
1,600. So we count to the 10% debentures now. 10% debentures will be 0.1 multiplied by 30,000. And that will give us 3,000. What is the total interest that we are paying? What is the total interest that the entity is paying? Would that be 1,000, 1,006 plus the 1,000 plus 1,600 plus 3,000? Would that give us 5,600?
Yes.
Okay. So the total interest that you are paying, is 5,600. This total interest, what is the total amount that you are paying the 5,600 on? What is the total amount?
60,000.
That is 60,000. So you are paying this total interest on a total amount of 60,000. So the question now is, what percentage of 60,000 will give us the 5,600? So we call that one WACC. Okay, the weighted average cost of capital. So what percentage of the total amount that we have, the total loan that we have, that will give us the total interest that we are paying? So that will give us 5,600 divided by the 60,000 multiplied by 100. What are we having?
9.33.
Okay, so we have 9.33%. So this is our interest rate. So any money that we are taking from any of these funds, it is attracting interest of what? 9.33. So if we have taken 10,000 for the whole year, that will be 0.933 multiplied by 10,000 Ghana cedis. What are we having?
Nine three three zero.
300.
Okay, so we have 933,300. So this will be the borrowing cost for this year, because the money has been taken for full year. So the assets have been there for full year. Let me do different one before I will say something about general borrowing. Okay, you can also do this. You can also calculate this like this. Your borrowing cost can be calculated like this. Okay, let's come here. You can see that it is 60,000 that is giving us what? 60,000 for full year. That is giving us 5,600 as interest. Do you agree?
Yes.
Okay. So if you are using 60,000, you pay interest of 5,600 for a whole year. But you are taking only 10,000 for a whole year. So if 60,000 is 5,600, what will be 10,000? So I can say 10,000 out of the what? 60,000 multiplied by the 5,600. So you'll be getting something like the 933 something if the approximation is right. Okay, so you can also do it like this. You find the total interest, you find the portion that you are using divided by the total amount multiplied by the total interest. So you get the same answer. instead of us using the WACC. WACC is calculated as the total interest over the total amount multiplied by 100. Total interest. So WACC, the weighted average cost of capital, is calculated as the total interest on the available funds, which is the general borrowing, okay, divided by the total amount. That is the total amount available before you are taking the money from it. Okay. Let's come here. If you come to general borrowing, time apportionment is very important. Okay. Let's come here. We are not taking this money specifically. We are not taking this money specifically for the construction of the assets. So you only charge interest on the amount that has been used. Because this 10,000, we might be taking the 10,000 for a lot of projects. So if you are deciding to use 2,000 on the project, what is the interest that we are paying on the 2,000? That is what we charge, because the remaining 8,000 over here will be used on different projects, which the interest will be charged on them there. But for specific borrowing, we are taking the money for only one project. There's no project there to share the what? To share the interest with us. So it means that the total interest will be taken to that one because we are using the money for that particular project. That is why we charge the interest on the total amount, whether you have used all the amounts or not. But if you are taking the money to finance a lot of varieties of projects, it means that the interest will now be shared among them. So if you're using 2,000 on the project, you only incur 2,000 on this one because you are not taking this money specifically. So it means that this 8,000 will not be in the account. This 8,000 will be used somewhere. So the interest on that particular amount will be matched against where the money or the activity that we are using the 8,000 on. So the interest will be shared among them. You can see that we have shared the interest among the building here because we are taking the money for two projects. So the general borrowing are taken for a variety of projects. So the interest will be shared among them. So we only pay attention to the amounts used on the project. Okay, let's come here. We also pay attention to when the money was used on the project. Okay, this loan can be taken. This loan can be taken like, let's see, January 1, 2019. But we have started our construction on March 1, 2019. Okay, what it means is that the construction was this date and the loan has been taken 3 months before the construction. What it means is that for the first 3 months, this 2,000 has been used elsewhere. So the loan, the interest for that one will go there elsewhere. The interest for that one will go there elsewhere. But we are interested in the portion that will come here. So our interest will be 0.993 multiplied by 2,000. This has been used on a project for only 9 months. So we do 9/12. It means that the first 3 months will be taken to where the loan has been used, or will be taken to profit or loss if you like. Okay, the period under which the loan has been taken, but there was no construction, that particular period, the interest that you are going to be paying to be taken to statement of financial performance as an expense because there was no assets in that period, but you pay interest for that period. That will be taken to what? Interest expense in the statement of financial performance. Capitalization starts from when the asset is what is under construction and the money has been used on the asset. So we pay attention to when the funds has been introduced and the portion of the money that has been used, because the interest, the funds will be what will be used or will be spread over a lot of investment. So we share the interest among them. So we are only interested in the portion of the money that has been used on the project. So let's pick two situations, and I will come and tell you something on the question number 3 there. But before that, let's try the example over here, and we see what we can do. Okay.
Please read it as for us.
Yeah, someone should help us because we have 20 minutes now. Okay. If the reading cannot be done, we will take it by force and read ourselves, please. Ladies should help us.
Example 1. On 1st January 2086, Malco Foundation began construction of a qualifying asset, a piece of machinery for a hydroelectric plant. It it issued a 5-year 150 million cedis debenture for a specific construction of a plant. Other existing borrowings were used for the construction when necessary. Expenditure drawn down for the construction was 180 million on 1st January 2086, 20 million Ghana cedis on 1st October 2086. Malco had the following loan in place at the beginning and the end of 2086. The items and their respective amounts are there required. Calculate the borrowing cost that can be capitalized for the hydroelectric plant machine at the end of December 31st, January 86 reporting period.
Okay, so let's come here. So this one, you'll be seeing this often. Okay, you'll be seeing this often where they'll be giving you information on this one. They'll give you beginning and they'll give you ending. Please. Okay. Someone can say that, okay, loans are always paid in what? In arrears. Someone can say that loans are always paid in arrears. But it can also happen that you'll be paying the loans monthly. The repayments can be done monthly. The repayment can be done quarterly. The repayments can be done semi-annually. So if they can give you something like 120 over here, and they'll come and give you 100 over here. It means that you have paid a loan of 20 million during the year. But the question is, when are you paying the loan? Are you paying the loan at the end of the year or you are paying the loan at the beginning of the year? If you are paying the loan at the beginning of the year, it means that interest will be charged on only 100. But if you are paying the 20 at the end of the year, interest will be charged on 120. But we don't have information as to when the loan has been paid, whether they are paying monthly, whether they are paying quarterly, we don't know. So what we do is that the interest will always be charged on the what? On the closing balances, because we don't know when the loan has been paid, unless they have given you information that the loans are always paid in arrears. What it means that you are going to be doing the repayment at the end of the year. But we don't know when the principal has been paid. So let's just calculate the interest on the available amount that we have on the loan. So the interest is always calculated on the closing figure. That is not a problem there. So this one, they are all the same. So whether you calculate on opening and closing, it will still be the same figure. But it can happen that it will be different. Okay, let's come here. So we are constructing what? Hydroelectric what? Plants. Okay, when construction for this particular one started, when the construction starts for, or when the construction starts for this particular project.
January 1, 2006.
Okay, you can see that we have also obtained funds specifically for the construction of this asset, isn't it?
Yes, sir.
Okay, and the amount is what? We have obtained what? 150 million. Okay, so if you have taken a loan to finance whatever you do, before you even go outside to go for additional funds, it means that you have to use the amount that you have taken. You have to exhaust the amount that you have taken before what? Before you even go. So you can see that the expenditure drawn for the construction was 180. What you do is that the specific borrowing must first be utilized or must first be used on the construction before you go elsewhere. So it means that this loan we have spent what 180 on a project on 1st January 20x. 20x. What it means is that 150 out of this amount is a specific borrowing. We first of all spend on it because that is the amount that we have taken. So we use that amount before we think about whatever what 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 else. Okay, and this 150 has been used over here. There will be a general borrowing of 30 million. That is 1st January. Okay, on 1st October, then you will still make a withdrawal from the general borrowing of 20 million. Okay, so what you have to do is that your borrowing cost over here will be in two folds. We have a specific borrowing and we also have the general borrowing. So let's come to the specific borrowing. So I'll have example here, Malco Foundation. Okay, so let's come to this one. I will be having specific borrowing. So the specific borrowing is 150,000 and that has been taken on 1st January and the construction also starts on 1st January. So it means that will be a full year, a full year, uh, that will be a full year interest expense. So we are taking that at the beginning of the year, and construction also starts at the beginning of the year. So we have 0.09 multiplied by that figure. So we have 0.09 multiplied by 150 million. Please, how much are we having?
13.5.
Okay, 13.5 million. So we come to general borrowing now. So the general borrowing, we need to establish our what? Our work. So I will do the work. And I'll also do the other one. You pick the one that you like. So we have the general borrowing. So we need to calculate our work first. Okay. Our work will be the total interest plus the total interest divided by the total amount. Okay. I'll do the total interest over here. So just look at it. Consider my total interest is 0.1 multiplied by 120 divided plus 0.08 multiplied by 80, all divided by 120 plus 80 multiplied by 100. Do you agree?
Yes.
Okay. What are we getting at the top? What is the total at the top?
18.4.
Okay, so we have 18.4 divided by 200 million multiplied by 100. What is our answer now?
9.2.
Okay, so we have 9.2. So we go and establish the amount that has been used on the general borrowing, the amount that has been used for the general borrowing. So identify the dates and how much has been taken out of the general borrowing. 1st January, have we taken any amount for the general borrowing? We have taken 30 million, isn't it? Okay. And that will be used on a project from what? From January to December, isn't it? So we come here and have interest expense. That will be January to December. And that will be 0.092 multiplied by 30 million. We have used 30 million. In total, we have taken 15 million, but they are not taking on the same days. Okay. So we have to do it separate. So what are we having for that particular one? What are we having?
2.76.
Okay,
2.76.
so we have 2.76. So we come to the second one, which is a 20 million that has been taken because the specific borrowing has been exhausted on 1st January. So we have used 180. It means that 150 has been used from specific borrowing. That is a full year, January, and the construction January. So we have to go to our general borrowing now and take this figure, take 80 million from that. That will be used on the project for a full year. So we now come to October to December. We are using 20 million. How many months is that?
Right.
Okay. So that will be 3 million. So it means that the loan has been used elsewhere for the last 9 months. The interest will be taken to where the loan has been used. So we have used this loan somewhere before taking it over here. So that 9 months interest will be taken to wherever this amount will be going. So how much are we having as the interest expense?
0.46.
Okay, 0.46. So what is the total? What is the total interest? The borrowing cost for the general borrowing would that be 2.76 plus 0.46? What are we having?
3.22.
Okay, 3.22. So let me do this one too. So my total borrowing cost now, total borrowing cost will be my specific borrowing, 13.5 plus the 3.22. That will be the total borrowing cost in respect of this particular one, which is going to be 16.72 million. Okay, let me do this one alternatively. I will do interest. So I'll be doing interest expense. So for the specific, it will still be the same. I'm doing this for general borrowing. I'll have January to December. Okay, let's come here. You can see that the interest that we are paying, the total interest that we are paying on the 200 million is what? Is 18.4, isn't it? Okay, but I'm using 30 million out of the 200. So 30 over 200 multiplied by the total interest of 18.4, because 18.4 is 200. Then 30 will be equal to what? I'm having something like the 2.76 million. Okay, then I'll come to October to December. That will give me, I'll have 20 over 200 multiplied by 18.4. That is a full year, but I'm using only 3 months, so 3 over 12. I'll be having 0.46. So you can add them. Okay, someone will ask for specific borrowing, for the amount that will go to profit or loss, the amount that will go to profit or loss is the interest relating to the period that the asset was not under construction. But if you come to general borrowing, assuming this loan has not been used, we should have been taking 18.4 to profit or loss. But out of this 18.4, 3.22 has been added to the cost of the asset. So the 18.4 is the total interest. But we have taken 3.22 to what? To the value of the asset. So 3.22 out of this has been taken to the value of the asset. What is the remaining one? 18.4 minus the 3.22. That will be the figure that will be taken to what? The statement of financial performance as an interest expense. We're supposed to charge total interest expense of 18.4. The 3.22 out of that has been taken or has been added to the initial cost of the asset. So it means that the remaining will be treated as an expense in the statement of what? Of financial performance. If they ask you for the cost of the asset, it is the amount that you have spent up to today, 180 and 20, that is 200, plus the borrowing cost, which is 16.72. Please let me pick one question on this general borrowing again. Then we can end everything here. Question number 3.
Question 3. Ministry of Education had the following loan in place at the beginning and the end of 2019. The 17.8% debenture stock was issued to fund the construction of a qualifying asset, a piece of drilling machine, construction of which began on July 1st, 2019. On January 1st, 2019, the ministry began construction of a qualifying asset, a piece of machine for a hydroelectric plant using existing borrowings. Expenditure drawn down for the construction was 60,000 on 1st January 2019 and 40,000 on 1st October 2019. Required. Calculate the borrowing cost to be capitalized for the hydroelectric plant machine and drilling machine.
Okay, so you can see that our general borrowing over here will be the first two loans, isn't it? Our general borrowing will be the first two loans. Is that correct? Okay, because they are saying that the 17.85 has been specifically taken to finance what? Construction of what? Drilling machine. Okay, it means that this loan was not taken at the beginning of the year. The loan has been taken on what? On July 2019. Do you agree?
Also,
Okay, and that is the reason why we don't have any amount over here, because we have only the amount at the end. So it means that the amount has not been taken at the beginning of the year. If the amount should have been taken at the beginning of the year, it means that January to June, the asset was not under construction. So this January to June, of the interest relating to this one will be taken to a statement of financial performance as an expense because there was no asset over there to add a value to. So we start capitalizing from 1st July, where the asset has been with the construction of the asset has not started. So since the loan has not been taken from January, it means that there will not be any interest from January to June before the construction starts. We assume that the construction is going to be the loan has been taken at the day that the construction has been done. And that's why we don't have any opening balance here. So we have all inclusive. So the loan has been taken during the year, and that is going to be the 1st July. Okay. They have not given us information on whether the construction has been completed or not. Okay. So during 2019, how many months has been spent on the construction of the drilling machine? How many months has been spent?
6 months.
Okay, that will be 6 months. So I'll have the Ministry of Education here. So I'll have drilling machine over here. Drilling machine. So the drilling machine, I'll have the interest expense or the borrowing cost. And that will be 0.178 multiplied by 300,000 multiplied by 6/12. What are we having?
53,400.
53,400. So this is a borrowing cost for the drilling machine. Very simple. The specific borrowing is always what? Very simple and straightforward. So let's come to the hydro watts plants. Hydroelectronic plants. So hydroelectronic plants. So I have hydroelectronic plant. Okay. So I have to do the work. So I have to
Sir,
do
please,
the work.
It's supposed to be a 26,700. I charged the previous, sorry.
yes, 26,700.
Okay. 26,700. So we need to do the work now. Okay. So the first one, the interest for the first one will be 20% on 240,000. So we have 20%. So we have 0.2 multiplied by 240,000 plus. Okay. This one, the interest will be calculated on how much? 19% on what? 19% on how much? The second loan
Okay.
60,000.
1,000.
on the 16,000, on the 60,000. Thank you. So 0.19 multiplied by 60,000, all divided by 240,000 plus 60,000 multiplied by 100. So what is the interest? What is the total interest at the top? Someone should do it and give us the total interest.
Fifty-nine, 400.
59,
400.
okay, 59,400. So what will be the work?
19.8%.
19 points.
8%.
Okay, so our interest, let's come to the borrowing cost now, which is the interest that I'm mentioning over here. Okay, the borrowing cost. So we have done two withdrawals from the general borrowing. So the first one, on 1st January 2019, the ministry began with construction of a qualifying asset, a piece of what machine for for a hydroelectric plant using existing borrowing. Expenditure drawn down for the construction was 60,000 on 1st January. So we have drawn down what 60,000 on 1st January. This will be used on the project for how many months?
The
The
full year.
full 12.
Okay, so we have January to December. That would be a full month. So we have a 0.198 multiplied by the 60,000. How much are we having?
11,880.
Okay, so we have January to December. So let me bring this one up. Okay, so we have the 0.198 multiplied by the 60,000. Okay, so 11.
880.
Okay, so we now have the second one. Please, we say that the when you come to general borrowing, you see this amount that we have over here, they are taking for a lot. They are not taking for the construction of whatever plant. They are taking for different purpose. But since we still have surplus fund on it, we cannot go out to go and take money to finance. So we just use the remaining amount that we have on this one. So we are not taking this amount specifically. So this 240 has been spread over a lot of what? A lot of projects. So the interest will be spread over them. So what we are doing is that they're only the interest, we are using 60,000 on this one. So what is the interest that will be for the 60,000 that we are using? The remaining 180,000, wherever they go, their interest will be taken to that particular place. It's not a specific borrowing that will charge the interest on the full amount. Okay. This one, the remaining amounts will be allocated somewhere. For specific borrowing, that amount will not be used elsewhere. It will still be in the account. So you pay interest on the full amount. But for general borrowing, we are paying interest on the full amount, but the interest will be spread over lots of projects. So only 60,000 will be coming here for the full year. The next one on the 1st October 2019. So that will be from October to what? To December. So we have used this one for only 3 months. It means that the first 9 months has been used somewhere. The interest will be taken to that place. So we have 0.198 multiplied by 40,000. What are we having?
7,920.
Just for 3
7.
months. Oh.
Okay. Oh, sorry. That will be multiplied by 3/12. Okay. Sorry about that. So we have multiplied by 40 multiplied by 3/12. What are we having?
1980.
1980. Sorry, 1980. What is the total borrowing cost for? So total borrowing cost for the hydroelectric was plants. That will be 11,880 plus 1980. How much are we having?
13,860.
13.
860.
Okay, so let's come here. Our borrowing cost.
Specific one. 67.
Okay, our borrowing cost, which can also be calculated like this. So I'll do this. I'll do 60,000 over 300,000 multiplied by the full interest of 559,400 plus 40,000 divided by 300,000 multiplied by 59,400 multiplied by 3/12. Okay, that will give you the same answer. So we can also do it like that. The 59,400 is the total interest that we are paying on 300,000, but we are using only 60,000 or 300,000. So if interest of 59,400 is for 300,000, then how much will be for 60,000? So 60 out of 300 multiplied by 5,400. And we have used 40 for 3 months. So that will be, this is for full year. The 59,400 is for full year. So 3 months we do that. So we'll be getting the same figure as the 13 whatever figure. Okay. I'll give you a very complicated one where you'll be calculating, sometimes they will give you a question where it will be a general borrowing and specific borrowing. So you'll be withdrawing, you'll be allocating the general borrowing to, you'll be using the specific borrowing in a bit, and you'll be investing. So you can take the specific borrowing from January. So you can take it from January. That January, you will not use all the amounts. So maybe you can use 20 million out of it. So let me come here. Let me label this place and demonstrate what I'm trying to see. Okay. So 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. Okay, so let me demonstrate what I'm saying. So sometimes they can draw down a period for you. So they can say the loan has been drawn down January. So they will give you the date. So they will say 20,000 has been used. So they can say that, okay, 1st April. So they can give you April 1. So they can give you something like April 1. April 1, they can say 30,000 has been used. Okay, then they can say October 1, 100,000 has been used. Okay, then they can give you like 1st December. Okay, 150,000 has been used. So they'll give you information on general borrowing and specific borrowing. So they can say that the entity has specifically borrowed 10% loan notes, 10% loan notes, 10% loan notes for let's see 100,000. Okay. They can say that this amount has been borrowed. This amount has been borrowed on 1st January. So what you do is that if you are taking money from a bank for particular project, you are going to be using the money that you are taking from the bank. If there's any shortage, then you now go outside there and go and look for loans. So they can say that this has been taken on January 1. Okay, so it means that the first payment that you are going to be making, the first payment, the first expenditure that you are going to be incurring will be from this particular figure. So it means that you have used 200, you have used 20,000 out of this, you have 80,000. So the question will tell you that this one, whatever be the case, your actual interest, because this is a specific borrowing, assuming you are not taking this to construct or to do whatever, you are going to pay interest of 10% on 100,000 for full year. So that will be 0.1 multiplied by 100,000. So that will give you 10,000. So we are only interested in the interest income. Whatever be the case, you pay interest on the full amount, full year. Sometimes the question can tell you that this particular amount, this particular loan note has been taken on April 1. So what it means is that the first payment was from a general borrowing because 1st January you don't have specific loan. So this will be from general borrowing. Then the subsequent one you start withdrawing now. What will happen is that if this should be taken on 1st April, our interest will be 9/12 because that we have taken the loan from April. So we start paying interest from April. That will be 9/12. Depending on whenever you are taking it, you just calculate it. But first one, we assume that we are taking it on first January. So we have used 20,000 out of that. Okay. We have used 20,000 out of that. So what will happen is that they can tell you that the entity always invests for the surplus funds at a percentage of 5%. Okay, so the question is, how do we calculate the interest income? That is my focus now. So the interest income. So let's come here. I'll do this one very simple here. Let's come here. We have used 20,000 out of the 100,000. It means that we are going to be having 80,000 in the accounts up to 1st April. So 1st April, you go and withdraw 50,000 out of that again. So I'll do you the interest in the 2 weeks. So you can calculate the interest income. So you have used 20,000. It means that you'll be having 80,000 in the account from this January to 1st April. That is 3 months. So you have 0.08. Let's say the interest income is 8%. Multiply by 80,000. Multiply by 3/12 because you invest this amount for only what? Only 3 months. Okay. So on 1st April, you go and take what? 30,000 for the amount that you have borrowed. It means that from 1st April, you will still be having 50,000 in your accounts because you have 100,000 and you have taken what? You have taken 20,000 first and you are now taking 30,000 from that. So your interest income will also now be from the interest income from that date. That will be 1st April. So 1st April, then you will now withdraw on 1st October. You will now withdraw 50,000 from 1st October. So 1st April to 1st October, how many months is that? The 50,000 will be invested for how many months? So you have 0.08 multiplied by 50,000. Multiplied by how many months?
6 months.
Okay, that will be 6 months. So you invest this for 6 months. Then on 1st October, you will now take 50,000. You use the remaining 50,000. Then it means that you will now fall on general borrowing of 50,000. So borrowing cost for general borrowing will start from this date. So you have to calculate your WACC. So the WACC, first one will be 3 months. Then the last one, 150, which will be taken from general borrowing again, will be 1 month. So your borrowing cost for this now will now be your actual figure for this minus the interest that you have earned for the period of this. Please, how much are we getting for the interest? Let's calculate those ones now. How much are the interest income for the first one?
The first one is 1,006.
Okay, so you have 1,006. Okay, this is what? The second one is what?
2,000.
2,000. So your borrowing cost will now be total interest. Whatever be the case, the interest, you pay interest on the total, then minus what? 3,600. That will be your specific borrowing. Then you just add your general borrowing, which will be 50,000 for 3 months, and 150,000 interest of 150,000 for what? For 1 month. I will also calculate this interest for you in a different way. Let's come here. Okay, I'll separate it. Okay, I will separate it. So I'll have the interest income. Okay, let's come here. We have taken 20,000. We'll be left with 80,000. Okay. On 1st April, we take 30,000 from that. Okay. So can we say that the 30,000 that we are taking from 1st April has been invested for only 3 months? The 30,000 that we are taking from the specific borrowing, can we say that it has been invested for only 3 months, January to March?
Yeah.
Yes.
Okay.
Yes.
So we can say 0.08 multiplied by the 30,000 over here, multiplied by 3/12. Okay, then we come to the interest income. You can see that we will now withdraw the remaining amount on 1st October, isn't it?
Yes.
Okay, and how much are we going to be using? How much are we going to be withdrawing from the specific borrowing on 1st October? Would that be 50,000?
50,000.
Okay, so can we say that the 50,000 will be invested from January to October?
Yes, sir.
Because we will not touch the 50,000. We have 80,000 in our account. We go and take 30,000 from April. We can say that, okay, that will be there from That will be there from January to March. Then we go and take it. So we invested it for only 3 months. But the 50,000 will not be touched until 1st October. So we can say that the 50,000 has been invested for 9 months. Do you agree?
Yes.
Yeah.
Okay. So you can add it. So you have your total interest income of what? 3,600. Anyhow you want to do it, you will be fine with it. So they can give you some information like this. So you just have to pay a critical attention to it. Whatever be the case, your interest on a specific borrowing will be the total amount that you have taken from the bank, whether you have used all or not. You pay interest on the full amount. So the interest on the full amount, depending on the months that you have been taken, the interest that we are going to be paying on the loan, the full amount. The only thing that you do is that you have invested. So we are only interested in the investment income that will be reducing our expense. That will be the only focus. So you pay attention to that particular one because I will give you a question involving that particular one, but I don't have it over here because if I put it over here, you people will force me to solve. So if it is not here, it means that you cannot say we should solve that one because there's no question here like that. Okay. So you look at that particular one. But we say that we have agreed that we will give the IPSAS question just together. So if you are done with the IPSAS, then assignments will be given together. Okay, I'll just pick two questions on all of them. So we just solve them and use them as well as the revisions for the IPSAS. Please, if there are no issues, it is six something. Thank you for coming and enjoy your morning and your day as well. I'll see you guys tomorrow where we look at IPSA 11 construction works contracts. Until then, please enjoy your day.